Someone just told you they're interested in selling you their business. That's exciting, but do not make them an offer yet. Before I ever start talking seriously about what I'm willing to pay, I want to know, what am I actually buying? And that's where the due diligence starts. First, sign an NDA. Before the seller starts handing over their financials, client information, pricing, and other confidential information, you need an NDA, a non-disclosure agreement, or a confidentiality agreement. Basically, what you're agreeing to is, what I see stays confidential. Once that's signed, now I can start digging. Second, show me the numbers. I want to start with the financials. So I'm going to ask for things like 3 years of business tax returns, 3 years of profit and loss statements, 3 years of balance sheets, current year-to-date financials, accounts receivable, accounts payable, debt information. And that's when I can start comparing. Do these numbers actually make sense? Does the revenue on the P&L make sense compared to the tax returns? Does the balance sheet make sense? What's happening with the debt? What's sitting in accounts receivable? How old is accounts receivable? And there may be things that don't match, because if something looks weird, don't explain it away. That's when you need to ask why. Third, show me the revenue. This is a big one. I just don't want someone to tell me my company makes $500,000 a year. Okay, that's great. Who's paying you that $500,000? I want a client list showing what services those clients receive and how much they pay. How much revenue is reoccurring every month? Big one. How much is a one-time revenue? And is that revenue spread out across a lot of clients, or does one huge client make up a big portion of it? Because let's say I'm buying a $500,000 business and one client represents $150,000. What happens if I buy that company and that client leaves? I still bought the company, I still have the loan, I still have the expenses, and now a huge chunk of my revenue just disappeared. That's called client concentration. And we're going to talk more about that because it can completely change how I look at a deal. Here's the biggest thing I want you to remember. When someone finally says, I am ready to sell you my business, it's really easy to get excited, especially when you've been looking for acquisitions. But your job during the due diligence is it's not to convince you to buy the business. Your job is to find the reason why you shouldn't buy it. Look for the problems, ask the questions, make the numbers prove the story you're being told. And if everything continues to make sense, then and only then can you move forward. Eventually that can lead to a letter of intent and actually putting a proposed deal on paper. But we're not there yet, because first we need to figure out whether this business is actually worth what the seller thinks it's worth. And that's where we're going next. In part 6, I'm going to show you what I start looking at in the financials, including some of the things that can make a business look more profitable than it really is. So follow me for part 6, because this is where the numbers really start to get interesting.